In December 2022, Carvana's stock was worth $4 per share. The company had $9 billion in debt. Analysts were openly predicting bankruptcy. By January 2026, the same stock hit $486, a 10,000% return in 2 years. Either this is the greatest corporate comeback in modern history, or someone is not telling the truth. To understand what happened, you need to understand what Carvana actually is. Ernie Garcia III founded Carvana in 2012 with a simple but ambitious idea: sell used cars entirely online. No dealership, no negotiation, no salesperson breathing down your neck. Just browse, buy, and have the car delivered to your door. The visual centerpiece was the car vending machine. Multi-story towers where customers could pick up their vehicles like a giant coin-operated dispenser. They were Instagram-worthy, memorable, and functioned as brilliant marketing. For years, growth was the priority. Carvana expanded aggressively, buying Adisa, a major auto auction network, for $2.2 billion in 2022. Revenue doubled, then doubled again. Then the pandemic hit, and Carvana, with its touchless delivery model, was perfectly positioned. By August 2021, the stock had reached $370 per share. The company was worth $60 billion. It was the poster child of pandemic-era disruption. Then interest rates rose, used car prices normalized, and the bill came due. By the end of 2022, Carvana was in serious trouble. The company had accumulated approximately $9.2 billion in total liabilities. It was burning cash at an alarming rate. The Adisa acquisition had added significant debt at exactly the wrong moment, just as interest rates were rising sharply. The stock collapsed 99% from its peak. In December 2022, it traded below $4 per share. Short sellers were circling. Analysts were openly modeling bankruptcy scenarios. The most shorted stock in America was not a failing startup. It was the once beloved used car disruptor. The Garcia family, Ernie Garcia II, the father, and Ernie Garcia III, the son, together control 88% of Carvana through special voting shares. They had built the company together, and now they faced losing it. What happened next is either a story of extraordinary operational execution or something more complicated. In 2023, Carvana executed what many consider one of the most aggressive corporate turnarounds in recent memory. First, they restructured the debt. In a landmark deal led by Apollo Global Management, creditors exchanged unsecured debt for new senior secured notes, extending maturities to 2028 and eliminating the immediate insolvency threat. Creditors also accepted a $1.3 billion reduction in debt face value. Second, they cut costs with remarkable discipline. Headcount was reduced. Unprofitable operations were closed. The focus shifted from units sold to profit per unit, a metric called gross profit per unit, or GPU. The results were dramatic. Carvana reported its first full-year profit in 2023, approximately $810 million. In 2025, revenue reached $20.3 billion, up 49% year-over-year. Retail units sold, 596,000, up 43%. Adjusted EBITDA hit $2.24 billion. The company was added to the S&P 500. The stock went from $4 to $486, a 10,000% return in roughly 2 years. But then, in January 2026, something changed. In January 2025, Hindenburg Research, a prominent short-selling firm, published a report calling Carvana an, quote, accounting grift for the ages. They disclosed a short position and accused the company of a, quote, father-son accounting grift. The key allegation? Carvana was selling approximately $800 million in loans to an undisclosed related party, potentially connected to DriveTime Automotive, a company controlled by Ernie Garcia II, the CEO's father. The concern? Carvana generates a significant portion of its profit by originating car loans and then selling those loans to third parties, booking an immediate gain. If the buyer of these loans is a related party, the pricing of those transactions becomes a significant question. In January 2026, Gotham City Research escalated the allegations. Gotham obtained DriveTime's 2024 annual report through a Freedom of Information Act request. Their analysis claimed Carvana's 2023 and 2024 earnings were overstated by more than $1 billion. The specific mechanism alleged, Carvana sells loans to Bridgecrest, another entity connected to Garcia II, at inflated values, booking an immediate profit. Bridgecrest then writes down the value of those same assets by up to 15%, approximately $900 million, on its own books. If accurate, losses are effectively being transferred from Carvana's public books to the private books of related entities controlled by the founding family. Carvana called the allegations, quote, inaccurate and intentionally misleading. The CEO stated on the earnings call, "We don't sell loans to related parties." The company says it voluntarily contacted the SEC. The company says it engaged outside legal counsel. The company says everything is properly disclosed. What the company has not done is provide a detailed line-by-line rebuttal of the specific transaction data in the Gotham report. Here is what makes this story genuinely difficult to assess. The case for Carvana is real. The operational improvements are measurable and significant. GPU improvements are real. The company processes cars more efficiently and with better margins than before. Revenue and retail unit growth are genuine. The S&P 500 inclusion required institutional analysis, and Carvana says all related party transactions are properly disclosed in its public filings. The concerns are also real. 26% of Carvana's gross profit comes from gain on loan sales. The related party relationships between Carvana, DriveTime, and Bridgecrest are complex and controlled by the same family. Insiders sold over $170 million in shares in the 90 days before the allegations became public. The company declined to give specific Q1 2026 guidance, and the detailed rebuttal has not arrived. Separately, and this is important regardless of the accounting questions, Carvana faces a significant financial transition in mid-2026. The payment-in-kind interest period from the 2023 debt restructuring is expiring. The company will soon need to pay over $500 million annually in cash interest. This is a real financial test that has nothing to do with the fraud allegations. The Carvana story is not finished, but whether the allegations are proven or dismissed, 4 lessons are already clear. Lesson 1. A compelling narrative is not a financial analysis. Carvana's comeback story, from $4 to $486, is genuinely compelling. Extraordinary turnarounds do happen. But a 10,000% return in 2 years should invite scrutiny, not just admiration. When a stock does something statistically unusual, the question why deserves a rigorous answer. Lesson 2. Related party transactions require extra scrutiny. When a company does significant business with entities controlled by its founders or executives, the arm's-length nature of those transactions cannot be assumed. This does not mean fraud. It means the pricing, terms, and disclosure require more examination than transactions with unrelated third parties. Always ask, who was on both sides of this deal and are their incentives aligned? Lesson 3. Insider selling is data, not proof. Executives sell stock for many legitimate reasons: estate planning, diversification, personal liquidity. But when insiders sell significant quantities of stock immediately before negative information becomes public, it becomes a data point worth noting. $170 million in insider sales in 90 days does not prove fraud. It is a question mark. Lesson 4. Understanding how a company makes money is non-negotiable. Most people who bought Carvana stock knew it sold cars online. Far fewer understood that a significant portion of its profit came from originating and selling subprime auto loans, and that the buyer of those loans might be a related entity. The actual business model was different from the surface story. It almost always is. Always dig one layer deeper than the product. As of July 2026, Carvana is still operating. The SEC has not charged anyone. The company denies all allegations. The stock has recovered from its post-allegations low. Whether this is the greatest comeback story in used car history, or a more complicated story about accounting, related parties, and a founding family with extraordinary control, remains an open question. What is not an open question is this: the financial lessons this story illustrates apply regardless of how it ends. Compelling narratives, related party transactions, insider selling, and opaque business models are all signals worth understanding, whether the company in question is Carvana, Enron, or anything in between. Subscribe to Founders and Fortunes. Every week we break down the biggest financial stories, past and present, and find the lessons hiding inside them. Next week, the money behind Costco's $1.50 hot dog and why it is one of the most deliberately sophisticated financial strategies in retail history. I'll see you there.